celebrating 15 years of Young Turks.
Hello and welcome to this special edition of Young Turks Back to the Basics. Today on the show we are talking to a fund manager at a fund that has been investing in India for over 14 years. They have over $2 billion in assets under management, over 50 companies that they've invested in, 5 of which have IPO'd and 3 of which are over the $1 billion mark as far as valuation is concerned. I'm talking about SAIF Partners and I have with me Deepak Gaur, MD at SAIF Partners. So Deepak, quite a journey, 14 years and the numbers on paper look fantabulous, but the last couple of years for the VC industry in India has perhaps thrown up some lessons that the last 14 haven't. So for you in this period that we've seen of churn, late 2014 onwards, what have been the key learnings?
Yeah, I think last 18 to 24 months have been very instructive to everybody, both to founders, to fund managers. The first big learning is that capital, while it is a great enabler in terms of building a business model, but it cannot substitute for sound economics and a business model, and also using capital always to short circuit the life of the company always is not a great strategy, because some things take time, whether it is developing support networks, infrastructure or organization, and if you want to do 3 years job in 6 months, there is a lot of damage that is caused.
And would you say that to a certain extent, and perhaps you can speak from experience over here, that there has been pressure for companies or for investors that have done that 7-year, 8 cycle to show returns, and perhaps that was the reason that we were seeing some of the short circuiting, like you put it?
So I think it was less driven by investors' desire to make quick returns. It was more driven by the fact that there was a lot of liquidity in terms of investors investing large amounts of capital at high valuations. And when a company absorbs that much capital, obviously there is a natural desire to deploy it, and which means that many times companies differ from what their core is in terms of service areas they should focus on. Also, that capital allows the flexibility to at least try and grow faster. Also, the desire to establish or reduce takeover competition and gain as much market share, that caused a lot of it. Because if you look at it, it's not that there has been great investor liquidity returns over the last 2-3 years. So I don't think that was the root cause. In fact, what we had seen in terms of our deal sizes was that across stages, every company was pushed one stage above. So if you were supposed to raise a seed stage round of $1 million, you were raising $4-5 million of Series A institutional capital, and Series A were raising check sizes of $10-15 million, which is Series B. So everything was kind of short-circuited by 1 or 2 cycles, and that's what caused a lot of it.
In that sense, Deepak, what has SAIF been doing over the last 2 years, and would it be fair to say that you all have been more selective in your hypothesis, gone back actually to the table to look at, hey, should we be putting in money at these higher valuations? What has been the thought within the firm, when you talk to your partners and you all looked at what you all should be doing? Also, it can be tempting when you look at the other funds in the market of a similar vintage, deploying aggressively.
Yeah, I think there were 2 fundamental pillars of our strategy over, I'd say, not just 2 years, over the last 4 years. And one was we were very cautious and wary of investing late stage capital, large investment checks at very high valuations. Because our core bread and butter is early stage seed, Series A, Series B, where we are either the first or second investor in the company. At those stages, valuations are still reasonable, the check sizes are small, the risk reward is still favorable if the company grows well and it performs. So that was one very large focus that we did. So if you look at our investment sizes, except for existing portfolio, we have invested large checks. We did not invest large checks at high valuation in newer companies, very few. Second was, I think we have this deep belief and conviction that for a long time, that just copying business models that have worked in US and China is not something that will work in our country. There are a lot of unique aspects and a lot of unique problems to be solved. So we had this bottoms-up approach of solving businesses or backing businesses which are solving India-specific problems or solving global problems in a very India-specific manner. And whenever we invested even early-stage capital, we used that lens quite a lot.
All right. Since this is about back to the basics, I'm going to ask you why India is not the US. and more currently why India is not going to be China. What are some of the fundamental differences that perhaps we got wrong? Because I remember back in 2014 when we were working on the Young Turks book, across the board there were 13 entrepreneurs that we featured across B2B as well as B2C businesses, and a lot of the founders talked about, hey, we visited China and we looked at the business models there, and we were blown away, and we've tried to bring some of that DNA here. But clearly we're seeing that India is not China. In what aspects are we not there yet?
So let's disaggregate that. I think what fundamentally what we are saying is that India today in many parameters is whether it is infrastructure, whether it is size of the economy, per capita income, technology adoption, is not at the level of China or US. That in no way means that we will not be as good or even better on many of those dimensions. I think our trajectory is very strong, and coupled with all other softer pillars that we have, there is a very high chance that we could do even better than that. But that does not mean that today we start behaving or start aspiring for those things that have taken 15, 25, 10 years in those countries in terms of building those businesses of that scale, and try to replicate that overnight over 12 months. And we try to do that, I think, without building the foundation. That's when problems happen, and that's where a lot of issues came up. So if you look at many of the Chinese companies, they have been cash flow positive, profitable, and have used those investments to fuel growth or invest in adjacent businesses or develop that ecosystem. In India, we saw a case where companies were themselves not profitable but investing all across or expanding too rapidly, and I think that was a big difference. So I think if we allow little bit of luxury of time and be patient, as well as do more fundamental bottoms up analysis of the problems we are solving, there is no doubt in our minds that we will achieve those metrics or even surpass them.
Has the presence of some of the bigger players from both the US as well as China looking at the Indian market or setting up base here and trying to get things off the ground, more than trying to get things off the ground, especially in the case of Amazon in the e-commerce marketplace, that actually intensified or perhaps led to some irrational decision making in terms of trying to achieve something that Amazon can very easily do, because it's a sort of endless pool of capital that they have
no, of course, I mean, obviously, but if you step back and look at it, one of the big reasons is that global companies are able to, or only in those segments global companies are able to take away market share when there is no India specific innovation, or the India specific innovation is too not deep enough. But if you do very deep bottoms of problem solving, if you solve a problem that they have also not solved globally, then there is no reason why.
Give us an example from the SAIF portfolio, and I'm asking you this, and perhaps you can put it in the context of your core India hypothesis, right? What are these India specific problems that we are solving? What are some of the bets that you've made in this space that automatically gives the business a moat that no one can take away?
Yeah. So I'll give you 3-4 examples, not just one. So if there is a logistics company in our portfolio, Revivo, which contrary to all investment logic at that point in time owns trucks on their balance sheet, but they run a very efficient relay-based model, delivering on by road timelines which match air freight timelines. And it is a model which has never been done anywhere else. It solves a very India specific problem where the road transit times are extraordinarily long, either because of breakages, stoppages, or because of shortage of drivers. And they have been doing phenomenally well, growing across verticals. Similarly, there's a food delivery company, Swiggy, which unlike the normal model in US and China, which is purely aggregation and demand generation, from day one they got all the delivery boys on their rolls and controlled delivery. And that ensured that while initially the manpower intensity was high, but the business is far more defensible, the customer experience is much more better. Then similarly in the budget hotel space, we have a company, Trivo, which unlike again doing a pure aggregation layer, which is just technology driven and can easily be replicated, they decided to take full control of a hotel from operations, quality control point of view, and full inventory, so that they are the only people generating demand for that. It's again a model which has not been exactly done in US or many other countries. So if you look at a lot of our portfolio, company by company, furniture company, Urban Ladder, which again plays a very crucial role in ensuring quality, giving inputs on design, controlling the entire customer service experience, warranty claims. Is that something that you have to do in India to earn back the trust when somebody is spending 20,000-30,000 rupees on an online transaction?
You what have two of your portfolio companies, and I'm going to just delve a little bit into that to understand the core hypothesis a little better.
Yeah.
One of them is Swiggy. So I think last year, a year before, food tech was the sort of flavor of the season. We've seen almost all the companies that came up in that space die either a natural death or be consolidated. Swiggy has of course continued operations, though gone through a difficult patch itself. What do you think will be the future of this space, and do we very easily or erroneously label companies? I mean, is Swiggy actually food tech, and what is food tech? I would think in a country like India, food tech should be solving agricultural problems and problems of our farmer, and not really getting an order to you faster in a big city like Bombay or Delhi.
Yeah. No, I think you've raised a very larger question, that what is a technology company in India? And if you look at it, there are very few companies which are pure technology. And technology could be anything. It could be biotech, it could be engineering, or it could be software technology. A lot of the companies, and at least the way we look at it, that they will scale, they will achieve the unit economics only by leveraging technology, and technology plays a key role in their business model. So even in Swiggy or Rivigo, so for example, just the whole dispatching algorithm, what should be the route planning, ensuring proper MIS for every restaurant, what kind of commission you should charge, all that cannot happen without accessing technology. But does food tech mean that we are solving technology problem? No, ultimately we are solving a food problem. And the insight in Swiggy was that unless your food gets there in proper time, it is useless, and it does not matter whether you get 20% extra discount on it. And that's the business model which has worked very well. Today they are doing almost more than $80,000 orders per day across very few cities, and growing very fast in a improving unit economics manner.
So unit economics, the new GMV of sorts. We'll continue this conversation on YT Back to the Basics after the break. Keep watching Young Turks.
Celebrating 15 years of Young Turks.